So there are certain challenges in terms of the implementation of the guideline because some of the companies could be the larger size, some of them could be in the mid size, but still like the earlier guideline which RBI has come up in terms of asset classification. In this guideline, I think it's going to be straight for all the companies. So keeping that in the mind, today we have a very special guest. Who has about 26 years of experience in this industry. Uh, Now, I would like to welcome again Mr. Durga Prasad, who is the EVP and the CIO and also the CTO, and who specializes in the digital transformation, technology risk management, who also into the project management and including agile DevOps, and also has led a lot of digital transformation, within Chola. So on behalf of the Institute of Internal Auditors India Madras chapter, I would welcome Durga Prasad for today's session, who will be our special guest, and also who will also share his thoughts and his practical experience in terms of how they are looking into this guideline and how they are also going to implement it. And probably it's always good to hear from such a great experienced people. And I also will be co-presenting along with Durga Prasad today. He has a hard stop for about 7 o'clock. So then we'll have some questions to be taken. If so, we're happy to take that as well. So welcome Durga Prasad for today's session.
Thank you. Thanks a lot, Karthik. And pleasure and honor to be part of this forum and share my experience with the other folks on this call.
Yeah, great. Thank you. So let's get started. So the digital lending guide is a story that exactly is the title today. We would like to know about the various factors, what are the various risks that the companies have to probably look into it, and what are some of the challenges implementing this guideline, the digital lending guideline. It's always not on the other side. There are also some of the practical challenges and what the company have to look for while implementing this, the guideline is what we're going to look at. Let's probably get onto it. Yeah. It's not on full presentation view. Yeah. So the first question is, what is fintech? Let's quickly talk about it. To be honest, as I say in other sessions as well, there are no specific definition for fintech in today's world. We can go to Google up, going to look into various forums. There is no defined definition on what is fintech. So thereby, I have kind of got the best definition what I felt was more appropriate, which I think Durga Prasad also will appreciate that. So any takers on what is fintech before we get started? Maybe 30 seconds, I'll pause here.
Any platform which enables to connect and deliver financial services products through technology.
Well, yeah, I think that's a very good answer. Yeah. So is this Kandan?
That was Narahari.
Oh, okay. Yeah. So let's look into what the definition says, which I was able to bring it out from various sources. Yeah. So the Financial Stability Board has defined fintech as technology-enabled innovation. It is just almost, I think, yeah. Technology-enabled innovation in the financial services that could result in a new business model, applications, processes, or products with associated, material effect on the financial markets and institutions and the provisions of the financial services. So there's exactly some sort of a definition that I was able to, bring it as what is called fintech. So before we get into this slides, I would like to give some background. Earlier, so the RE, which is today called as a regulated entity, which definitely is going to be RBI regulated entity that we will talk about, because there are other REs such as chit funds or the housing housings provision sections as well, which is predominantly moderated by state governments and also by the central government. So but today what RBI, this digital lending guideline, will be applicable only for the RBI regulated entity, which is NBFCs and banks. Now, giving a background, earlier it was that, where RE used to do a lending through the digital app, right? A digital app used to be owned by a fintech, or there'll be a loan service provider who uses the fintech the app or application to which the loans was getting disbursed. While a lot of issues popped up, which you also will talk about, where a lot of issues popped up around security, privacy, collection of the data, misusing of the data, the entity who was lending the loan, which could be an NBFC or a bank, they were never owning up the responsibility on what went wrong, right? So they were trying to, say that we are not responsible, we have not collected the data, and the fintech was not owning up. So the fintech or LSP that we're talking about, which was into the intermediate arm, was not being regulated, or rather was not being, having any overseeing measures either by the regulated entity, which is NBFC or a bank, nor by any other, the authority. So thereby, just middle arm in between the borrower and the regulated entity, this in between arm, the fintech or the LSP that we talk about, was not being completely, was not even being regulated, or rather there was no overseeing measures around them. So thereby, both of them were like blaming each other, right? So bank used to point fingers on the LSP, LSP will point fingers on the bank. So there was no ownership that was taken in terms of what went wrong or what's going around this entire the digital world in terms of the fintech or the digital lending from small loans or etc. To various loans. That is where this particular digital lending guideline, which has come in, if all of you would have read that guideline, the most of the responsibility today is being at fixed for the RE, which is your NBFC, which is your bank. So they are trying to say now you guys have to own responsibility, and you guys have to probably take responsibility in terms of the loans or whatever that you guys want to do it, right? But at the end of the day, RE will be responsible for any sort of an security issues or malpractices, misusing of the data, whatever be it. End of the responsibility will lie within the regulated entity. That is the whole objective of this particular digital lending guideline. So while we go through it in detail about each and every aspect of it, but the total objective which RBI is trying to take, which is the very first step, I would say, is giving fixing up the responsibility in today's world around the digital lendings on the using LSP or using their own apps, whatever be it, they have to be responsible for that. Yeah. Next slide.
Yeah. So, Karthik, if I may just add a couple of thoughts
sure.
here.
Yeah.
So, one is, like you have rightly put, there is a whole set of, technology-enabled organizations in the financial services space, which we call them as fintechs. But there is also a complementary definition of a different set of entities, which are called tech fins, where they are technology enabled, but not necessarily in the financial services space, but where they feel their ability to, plug in financial services on top of what they do can, broaden what they offer to their customers. So that's, for those who are very familiar with fintechs, there is an, analogous entity called TechFin that, comes into play where, the core business for them is different, where they can plug in additional financial services on top and, enable, more seamless operations and transactions and service delivery for their customers. And if you see, what's essentially going to happen going forward with the, open network, the whole, ability for any service provider, whether he's a financial service provider, it could be a, transportation or a supply chain, they can all plug in to, the open network to seamlessly provide financial services as a natural add-on to the normal course of services they deliver to their customers. So that's the one part on, fintech versus techfin. The other one is around, like you rightly said, if you take, the whole lending space, you have different stages that come into play. The first one is around how are you sourcing or onboarding customers? As part of onboarding, how are you working on, the credit underwriting aspect of, bringing on the customer, and then the whole loan life cycle management, and finally the servicing and collections aspect of the whole lending journey, right? And where the new guideline is now coming into play is, and like you rightly mentioned, the key responsibility for, the customer facing and making it more seamless and transparent and open for the customer lies with the regulated entity. So you may have a, digital lending app, you may have an LSP in front, but ultimately the regulated entity is primarily responsible for serving the customers, meeting the needs of the customers, addressing the grievances of the customers. Yeah.
Yeah. Thanks, Durga Prasad. Yeah. Moving to slides, just to give a quick background. So if you see in the this slide, the share of the different lenders in the loan dispersed to digital channel. If you look into FY 2020, the NBFCs, if you look into their share, has become 30.3%, while the private sector banks has shrunk to 55.1% from 65.7% from last year. And the public sector is also at 30.1%. So while this gives you a overview in terms of how the NBFCs are probably leading this digital lending loan disbursement, which is like more than they've doubled up from FY 2019 to 2020. That shows the enormous growth in terms of the digital lending guideline from through the NBFCs today. So while the private also is trying to put their share, but through NBFCs where we can see the enormous growth from a digital lending point of view. So moving to the next slide, which can give you an overview in terms of what the amount of the loans being dispersed compared to the number of loans. So there's also something called BNPL, which is like buy now, pay later. So if you look into the buy now, pay later, the total share of a number of loans is about 11.91%. Though it is very less, but the whole concern of the buy now, pay later is that the demand gets more, right? So you can also get around for 500 rupees or 1,000 rupees also a loan comes out today when you go to Amazon or a Flipkart. So if the buy now and pay later is not being regulated, then what happens is everybody, that spurs the movement for, purchasing. The purchasing power for the e-commerce becomes higher. So thereby the demand gets more. So there has to be some regulation in terms of on what basis do you provide that short loan, right? That becomes more of a question by the RBI. So the more and more demand gets in, the more and more the supply and demand chain will get into an issue, and then the cost will increase. And again, the whole cycle will get into the commencement. So thereby the buy now pay later, though the amount or rather the share that they have today is going to be less, but there requires a lot of regulation around that as well, because that also becomes in terms of how on what basis the loans are being disbursed, what is the rationale. So everything comes into that play. Now, if you look into the personal loan, 52.76%, it becomes, the growth. And while, you look into the gold and vehicle, which are like very minuscule rather, I would say, and others are at 34.42%. So the personal loan is where the NBFC dominate on the digital lending platform, where they issue the short loans and a longer terms of the 6 months to 1 year, etc. So I believe this personal loan, that product through which NBFC is trying to issue a digital lending platform, becomes more for today's talk as on today. Can you please switch the presentation to full screen? I'm unable to view the charts properly. Anup, can you get this addressed? Yeah. Represent that. So before Anup fixes, DP, you want to share some thought process on, yeah, great. We got that. Yeah. So this is something very interesting slide that gives you an overall, the overall, I would rather say the gamut of, the technology that gets into the fintech world today. Now, while you can see in the bottom, which is emerging tech for the fin services, It starts from RPA, quantum computing, cloud computing, API, biometrics, cybersecurity, big data analytics, AI, IoT. So these are all of these technologies are being played from one fintech to the other. So everybody uses it for the various reasons. But my take, maybe Dugar Prasad can also add to it, is that the data collation in terms of to which customer to be target. Now, if you look into today's e-commerce, many people are into e-commerce today. They purchase a lot of stuff. Now you have social media linked to Facebook, Instagram. A lot of these, purchasing happens over the Facebook and Instagram as well. The point today is that these platforms track all your activity, and that becomes a lead for these fintechs to reach out to you, stating that, do you want to purchase this additional, do you want to purchase, we provide you a loan for you to purchase that. So the data in terms of activities what we do in the social media platform, that becomes a base, so for targeting these fintech companies to sell their product. Second part of it is becomes your artificial intelligence, the program, which will do the entire logic or computation for you to fix the credit limit and providing a credit limit for you to take a loan or avail a loan. So these two become the significant, the part of, rather I would say, the technology which, the fintech today, probably plays around. I would rather use the word of play around, because those two becomes a key way of, reaching the customer and probably making them to take your product and thereby getting them to a fix, right? So that becomes a cycle of, how it got evolved, and rather getting into more of a problems. So that is where, even the RBI is also more concerned in terms of, how this data collation or, the data tracking, becomes regulated, plus how this artificial intelligence program, which a fintech will be using it to calculate the economic profile of the borrower, how do they increase the limit, what are the parameters they use it. So all that becomes a various question, which they also probably raise alarm today. But I believe the upcoming or subsequent the part 2 or part 3 of the guideline will try to address that as well. Dugdar Prasad, any thought from your end on this aspect?
Yeah, no, I think the key part, like you have mentioned, I think the fintech is, tackling on a very large scale on the base of a very strong data foundation. Now, if you look at the traditional financial institutions, they have a certain risk appetite. But I think the innovation that's coming from the fintech players is to see how can you tap on to, a person's, profile, whether a geographic location that they are operating in, or a kind of role they are performing, or, maybe in terms of their social media profile analysis, to say, is this person, credit worthy for us to lend to? And that is something which, a traditional bank or even say old style NBFC may not be immediately taking up from their risk appetite perspective. So what innovation fintech brings is key for, from a financial inclusion, and with a large digital penetration, that's a big way for us to bring more and more into the financial fold. But like you rightly mentioned, I think there is a clear border that needs to be, and a bit of gray area there in terms of what constitutes a way for me to use information to underwrite a customer versus what is stepping into their privacy zone. And that's the area where, the digital lending guideline is trying to make more and more explicit into what can be accessed, what cannot be accessed, what can be accessed one time, and so on.
Yeah, exactly. And any thoughts from you, DP, in terms of, the technology which, algorithm that creates the decision on how the lending can happen? And what is your thought process in terms of, how it can also get regulated?
So, I think, like I said, there are some parts that go into the gray area. It could be, in something as simple as, okay, if I want to borrow, can I give my social media handle to the lending app for it to analyze what I have posted, whom am I following? The same way, can it analyze my contacts to see, is there a certain risk in the contact list? Maybe is there a fraud profiling that happens to say, is there a risk to the contact list? Same way, there are some digital models where they see if the device you are running the app on is very new, which may mean that there is a potential risk that somebody is using a very sanitized phone to portray a very different image. So those are the areas where this comes into play in terms of what can be allowed, and these are all the models that ultimately play a role in decisioning to say, can I lend to this person, and if so, how much and at what rate?
Yeah. So as Durga rightly said, we call him as a DP because I got that name from working with him for many years. So as he rightly said, the digital apps today has a larger risk, right? So moment we install an app, and then it asks you to allow access to install, like allow access to the media, SMS, contacts, call logs. So while all of these are, while many people they're quite, they don't have knowledge in terms of what is risk beyond it, so they just give access to all of these, and thereby once access has been provided, and all of these data are being probably stored in the fintech cloud or fintech server. The very key in this is that one is security and the privacy aspect. The major part is that the misusing of these data, what has been collated by these fintech, they sell this to third parties, and the other third parties try to approach you with the same loan product. So thereby the misusing of the data, what has been collated, becomes a huge issue. Not only that, there are a lot of scams that happens where the Chinese and Hong Kong companies or rather these scammers, they try to steal your data, and then they start threatening you. So likewise, there are a whole bunch of cyber security crime that got involved. If you go to Google and look for the cyber security incidents around the fintech today, there are many suicides that have happened because people have been given loans without more than their capacity, and they were not able to repay, and these fintech started harassing them, and that has led to many suicides in in many states for that matter. So that is the whole issue. That's a very disturbing part of the business where the fintech is today is into, and that is where we're also going to look at how some of these can also be addressed. Yeah, next slide. So the concerns of the working committee. So the working committee is where they wanted to figure out how this can get addressed. So there were a lot of recommendations by the working committee. If you ask me honestly whether the RBI has taken all of them, the answer is no. While they have taken up the major concerns, rather they have formed a part one by trying to address the first layer. So their top two concerns are the customer protection is very, very important. Should follow an approach of open texture, rules and standards and responsibility rather than being a command and control. That's a very good keyword, command and control type, because today the fintech will command in terms of what you need to do. I mean, they start, once you take a loan from them, they start dictating. It's like a fix. Once you take a loan, you are into fix with them, and then they start controlling your expenses, controlling their purchasing, etc., and thereby you get into a debt trap, right? So there's no regulation around that. The proportionate regulatory framework for small players is certain key. For example, if you look at a larger fintech player, they may have a room to implement most of what RBI wants it to implement. But you look into small players, they may not have adequate room or a space to implement most of the guidelines what they have come up with today. So there's going to be a challenge. But the other point is that the risk in what the small players are looking today is much wider. They may not have proper security controls in place. They may not have proper technology in place. So thereby the problems what they would pose will be quite huge, because compared to what a larger or the bigger fintech companies what they may do. So likewise there has to be a regulation, because how the smaller companies are going to deal with the security issues today. And that is why they say, irrespective of whoever is going to be, as long as you're going to be in the business, you're going to collect the data, you have to get into those norms, or else you have to probably look for something else. That's a very, very clear message by the RBI in this aspect. So this guideline, has very explicit in terms of, reckless lending and predatory practices like debt entrapment, debt treadmill, and debt criminalization. The words are quite strong because, that is how the fintech was probably leading the entire business, which the RE was nowhere into picture. They were not even aware what's going on. So debt entrapment, as you have rightly seen on the screen, ensuring that borrowers will be unable to repay the loans and ultimately facing them to default. That's again a business strategy to build the interest, etc. And debt treadmill, finding methods that will produce a constant stream of fee payment from the borrowers to the lender. And then debt criminalization, making borrowers fear arrest if they fail to repay their loans. So these are some of the strategies, which was also put forth by the working committee, which was used by the fintech world today, to make to sensitize the operations, or the way the fintech was performing the business to the RBI. So customers often have limited resources and knowledge about the financial terminology, which prohibit them from understanding the complex financial products and services. For example, they may not even know what are the charges. They don't even know how the processing charges works, right? So they don't even know about the insurance. So they say you have to get insurance, or else we will not give you the. So they take the insurance again. So likewise, many customers are not even aware. They have a very limited knowledge about how all of these interest charges, all of it works. Rather, they are pushed to accept it because they want to take up this loan. And that is why, again, RBI through this guideline has come up very clearly that they have to upfront communicate to the borrowers. While we also will see and also hear from Durga Prasad more, while we go into real the content on the digital guidelines. Yeah. So, so what is that point is that, one, the major point is that the DLA is carrying the credit assessment by using the data and mostly catered to those borrowers who do not have a well-documented credit history. So the point is, they also started targeting the people who did not have a good credit history. So they started targeting those people, to make them to, because they'll be really hunger to take a loan or look for someone to pay you the loan. So they will probably go in there without having a proper assessment, whether they can repay it. Then the existence of layers between the borrowers and the balance sheet lenders leads to non-transparent and unethical loan pricing. So what happened is that, as all of us will agree, the fintech we used to charge more than what they used to agree with the RE. The charges what they would probably put to the borrowers much more than what will be. So they'll have an additional tap into it, and whatever that they were dealing with the borrowers, right? So they were not able to be transparent to the REs. So thereby RE was not even aware in terms of what they are trying to do, and also a lot of unethical behavior in terms of recovery mechanism, threatening them. So and other finally is the cost associated with the FLDG, where the fintech will say, irrespective of whether whatever loan you give it to me, whether they whether the borrowers they're gonna repay it or not, don't when I give a guarantee of repay 100% to you, right? So thereby RE was not even bothered. As long as I get my money, I'm not even bothered. So there was no cap on the FLDG percentage, which the fintech can agree with the RE, right? So thereby that is where RE was not even getting into all of this. So that is why now the RBI has stated there has to be a fixed in terms of FLD, though there's no clear percentage around it, but they're also looking in terms of how much FLDG can agree in terms of the the percentage that they can cover in case if the borrower does not repay the money, right? So these are again three major concerns in terms of what fintech is today into. So action taken against the compliance. So as per the press release on 6th dated December 23, 2020 by Reserve Bank of India, while they are cautioning public against unauthorized digital lending platform. So what the action was taken was removed for the policy. Most of the apps are removed for the policy violation. They removed them from the Play Store in India for failure to respond. Pending, these are typically most of the Chinese and Hong Kong players, where they steal the data without, they create a dummy app. And what happens, they upload the PAN card, Aadhaar card, and then they morph it as if the person has taken a loan, and then they start threatening them to repay it, where actually they wouldn't have taken a loan. They were not even aware that such app existed. Such kind of misusing happened with the Aadhaar card and PAN card. URLs did not link to any app, failing to provide NBS certification. Page URL did not identify the specific app. So these are some of the themes of issue which RBI was able to identify, and then the action was taken on those apps accordingly. Yeah. So quick mod on the fintech fast-growing market, covering only banks and NBFC. As I said, there are three layers to it. One is governed by RBI, NBFC, and bank. Like as I said, chit funds, right, which are being governed by the state bank, and some of them are also governed by the central bank, and some of them are not being regulated at all, right? So this particular guideline majorly focuses on the RBI regulated, which is NBFC and the banking. So in 2017 and 18, the private sector bank was 75% share of the digital lending, while NBFC had only 12%. In 2020, during the COVID time, the NBFC share went almost to 50%. That is the enormous growth what NBFC was looking into a digital lending platform. So RBI has seen some concerns in the NBFC which are in the space: the interest rates, recommending practices, fraud, mis-selling, data privacy, and the digital lending helps with a hassle-free process. There's also a talk whether should we ban the digital lending in India, to be very honest. But then RBI said, it is not possible because there's some innovation involved where the fintech started using AI, RPA, and they also started using IoT. So likely there is a lot of space for these technology growth in India. So thereby they failed. We can't ban them completely. Rather, there is required a regulation in terms of how it can be dealt with in a secured way. That is why RBI didn't want to ban them, because today the fintech will give a hassle-free loan, right? You don't need to submit the paper. You don't need to wait for everything happens in a click of button. In a matter of 2 minutes, the amount will be into your bank. That is the growth, and that's a potential what RBI also looked at. And that thereby they didn't want to ban it completely in India. And that is where and there also recent guideline, a large focus on the above specific data privacy, which are expecting the government to release it in a sooner time. That will also will throw more light into the data privacy. On the current scenario, entities to be responsible for the actions or activities performed in the DLA, SLA. The middleman was not being regulated, and then to vet and monitor the kind of agreement that bank enter into with the LSP in terms of mis-selling, charges, interest, privacy, and aggressive. So DP, you want to add something more to the current scenario before we go into actual the guidelines, which probably I'll hand it over to you for you to probably talk about it.
No, I think this covers the bulk of what has happened in this space. And like you mentioned upfront, right, a lot of this is on the back of some of the bad experience consumers have had with apps that were purely in the digital app store and led to some kind of either predatory lending, and then adverse outcomes for the customers, and like you said, in some cases even leading to I think the whole point was, while digital is the way forward, there is a significant digital penetration across the population today, and it serves as a rails for us to do lending on top of it. It is important that we progressively protect the customer when they come through this channel of borrowing.
Yeah, sure. So over to you, DP. Yeah, this is on the guideline. Yeah. Maybe you can talk.
Sure.
About
Yeah. So I will, start off with some of the points that you clearly mentioned, right? So the first thing is, in a typical lending scenario, when a customer comes in, either he has got, a bank or an NBFC with a physical branch out there, for them to clearly understand what are they, what amount they are borrowing, what are the fees they are going to pay, and what is the, ultimate interest and, the monthly payments that they're going to do as part of the whole borrowing cycle. Now with digital lending, the challenge is that there is no physical interface for you to say, here is a trustworthy connection for me to go and get clarifications from. So RBI, rightly said that, consumer protection is going to be the key when they come through this channel. And there are a couple of, simple things they have put as the initial protection base for the customer. So one of them is called the KFS, which is essentially, making it very explicit to the customer, what is he borrowing, what is the deductions or fees he's going to be paying upfront. So what is the net disbursement that's going to him or her? And what are the charges in terms of the interest rate and, that he is going to do as part of the payment. So which makes it very clear that, okay, here is something I'm borrowing for 6 months, 12 months or whatever. Here is the amount I'm going to pay. Here is what the total amount loan I took for, and what is the net disbursement I'm going to get at the end of, net of the charges. So that's the first part, which typically in a physical scenario, somebody would have, sat down and explained to you. So that is an essential, requirement from as part of the guideline that, you need to have the key fact statement shared with the customer when he or she is onboarded. The second part is, something which you would have been, familiar with in the insurance space, which is like your free look period. So similar to that, what, the regulator is asking is making sure that there is a cooling off or a lookup period for the customer. So he or she may have borrowed from a digital lending environment, and they have a period of time within which they can, revisit the decision to have borrowed from that particular entity. And all they can do is pay, whatever is the interest for that period within the cool-off period. And then, there is no prepayment penalty or anything for that period. And then they can move out of that particular loan arrangement. So these are, the initial protection pieces that, RBI is very clear based on what they have seen, in terms of experience and feedback from customers who, went through the digital lending cycle. So that's the first part of, customer lending. The second one that comes into play is, once a customer is onboarded, then it is the responsibility of the regulated entity to make sure that they. So maybe some background there. So I think the second part is around making sure the regulated entity is giving a clear mechanism for any onboarded customer to raise the grievance that they may have as part of this whole life cycle of the lending product that they are engaged with the regulated entity. So which means, whether it is on the website or on the app, they need to have a clear mechanism or communication to the borrower so that they can reach out to the regulated entity. So that's making sure that, you are not, dealing with a faceless or a, almost like a nameless organization. And there is a clear mechanism of, somebody addressing your concern. And if that is not happening, then there is a way for that to get escalated further to the regulator himself. So that's the second part of making sure from a customers, customer are protected, their interests are protected, both during onboarding and subsequently. Now, the third part that comes into play is around, what kind of data that, because the whole onboarding happens digitally, what kind of data should be collected by the, the digital lending app that is used by the customers for, taking up the lending product. So, in the guideline, there is a clear message in terms of, the app, avoiding accessing the mobile resources. So which means things like your contact list, your SMSs, because typically you would have heard of many people using your SMS as a way to profile your financial worthiness, accessing your call logs, and so on. So I think the whole idea is to make sure that, the privacy of the customer is protected to a very large extent. And any data access that happens from a digital profile of the customer perspective is purely for onboarding, and maybe to some extent, maybe as a one-time option to use for KYC and the whole approval mechanism that may happen as part of the lending product to be given to the customer. And each of these, so if it is accessing your camera, if it is accessing your photos to upload your KYC doc, all of that needs to have explicit consent of the borrower. So that's very important, because ultimately, consumer protection and transparency to the customer in terms of what is happening to his or her device is also a key part of the ask from the regulator. Now so what happens is, if there is a differentiation between the provider who is fronting the digital onboarding versus the regulated entity that ultimately manages the life cycle of the lending with the customer, it is important that the regulated entity has a very strong relationship and oversight of how the front-end digital app manages the customer data. So it is important that there is a rhythm of validation of what is being taken by the digital lending app, what data is used for onboarding, what data is persisted, and where it is persisted. So all of that become a critical part of, ultimately the regulator is going to ask questions of the regulated entity. The digital lending app is purely an onboarding channel as far as the regulator is concerned. So anything that goes wrong becomes, something that the regulated entity will be accountable for. So that's a big part of where, an NBFC that needs to sign up, or a bank needs to sign up with a digital lending app or a fintech partner, needs to have that confidence that the kind of data that is being used by the fronting app is managed with right data governance, right compliance to data privacy rules, and making sure that it meets whatever maybe the data residency requirements that the regulator has in place. Then finally, I think purely from a tech perspective, it's important that you have a clear view of what does the app entail. Is the if there are some basic information being stored by the front-end DLAs, is that meeting the cybersecurity requirements that the regulator may require? So whether it could be something as simple as VAPT for the fronting apps or the fronting environment, down to are the personally identifiable informations, even if they are passing through the the digital fronts, are they masked or handled in a manner that does not help anybody to go back and identify the customer from what information flows through them. So that's a from a technology perspective, that's a big part of where the regulated entity needs to work very closely with the front-end partners to do that. Now, besides that, everything else predominantly becomes the RE's responsibility. So it could be in terms of if there is a disbursement happening to the customer, the RE is responsible for that. If there is a fee to be collected from the customer, then it has to come to the regulated entity, and then regulated entity could pay whatever charges or fees it pays to the digital lending front separately. So ultimately, I think the focus here is that for the customer, the end relationship is going to happen with the RE. The digital lending fronts are purely a channel to ease the mechanism for customer to take on this product. And subsequently, the whole life cycle of the customer loan, the reporting to whether it's a credit bureaus or subsequent collections, primarily rest with the regulated entity. And that's where then it comes down to, the fact that, are we in a position to make sure that your underwriting rules conform to what you as a bank or NBFC follow, so that you are not doing any kind of predatory onboarding of customers. At the same point, making sure the way you collect also is in line with the regulators' guidelines. So, like you would have heard of somebody, some apps reading contact list of the borrower and then using that to send them, messages, or using that to, create the borrower to come back and pay. So those are the areas where any such behavior is absolutely prohibited, and the accountability of making sure the experience for the customer is not deteriorating rests with the RE.
Yeah. So
Yeah.
as Durga Prasad was rightly saying, you see some of the challenges in the digital lending space. So in terms of the operations, privacy, mis-selling, interest rates, business technology standards. Yeah. So you want to talk about privacy concern, Durga Prasad? Yeah.
Yeah, so this is, I think, like I briefly also mentioned, is the key in terms of what is it that, we should be allowing, or we should be, looking for when information about the customer is collected. So it's almost like, if you were the customer, what would you, feel comfortable sharing as part of the whole borrowing cycle, right? Would you like somebody going, social media profiles, or seeing through all your SMSs, or seeing through all your, buying pattern over the period? So these are the areas where, ultimately the whole part is, are we clear what is being accessed? Are we clear what is this being accessed for? And are we clear on what is that information that is being accessed, being used and stored? And is it a one-time usage, or is it going to be used for the life cycle of the app on the customer's device? These become the key part for us to say, are we working with a digital platform that is keeping the customer's privacy concerns as a critical importance in delivering services to the customer?
Yeah. So some of the security concerns is, again, as DP also rightly mentioned, it's in terms of, the data being collected, like the contacts, the privacy aspect. All of them were actually big concern in terms of, what are the various the contact information, photos, medias, and the SMS, phone logs. So all of these are being collected, and the major issue is that even though some of the customers want to move out of the digital lending app, still the data used to reside in terms of how they are dealing with it. So thereby the data was not erased, data was stored, and then they started the misusing and mis-selling of all the data. So thereby there was a big concern of security, how it was being dealt with. Major concern is how the data was being, the security of the data was being ensured, right? So that coupled with privacy was creating a lot of, the culture around, the misusing and the mis-selling of the data. So, and the responsible pricing, one is, the distillers are charging interest for the whole month, even though the dispersal does not take place in the beginning of the month. That was, and second part is the interest calculation should be done on actual days basis, and any fee that has not been disclosed to the board at the time of sanction, or not factored in while disclosing the app, and and then the interest amount must be charged in arrears and never charged or dividend in advance. So these are some of the issues around the pricing part of it, which which was supposed to be, but in actual, it was not the case, right? So, Dokar, any experience on this scenario, the interest part and also the charges part, which the fintech was probably playing around?
No, so I think some of the things earlier that were banned had exorbitant charges, and almost like they were taking advantage of the desperation of some of those borrowers to charge that kind of rates. So that's been a big challenge that we have seen, and that's something typically banks and NBFCs wouldn't be partnering with. So that's one part we have to be clear on when you are a borrower using any of these apps, to be watching out for what is being charged, what is kind of deducted as part of the payment there. And I think the second part, like I mentioned earlier, is that the whole clarity on how money flows is very explicitly clear in the guideline that it's the regulated entity that will directly disburse to the customer. So the digital platforms have no role to play in as a middleman in this whole thing as far as the financial money flow is concerned. Same thing happens with charges, unless there is a co-lending arrangement between the financial platform, which also may have an kind of a lending license, and then they co-lend along with a bank or an NBFC at the back end. But other than that, then then you may have an escrow kind of setup in place. But besides that, typically the regulator's expectation is that the financial flow needs to happen directly between the customer and the regulated entity.
Yeah. And if we talk about the key fact statements, which is again the where RBI wanted to have the clear communication on the charges, what will be collected as part of the key fact statement, and that should also get generated from the RE from RE. And the other point is that all the hidden fee structures and everything should be clearly articulated, but and use of any techniques by the digital lenders where they use the hidden fee structures, all that requires some sort of an supervisory action. All the contingent costs should be appropriately factored in the APR. This would enable disclosure of the cost in a clear and understandable way. This again from the pricing point of view. And then we also, other concern was on the disclosure should include monetary and non-monetary impact of early, partial, late, and non-repayment. This again, one of the key factor, which they also brought up. If somebody is going to repay the loan in the short term, how the charges and everything will probably will come into play, which we'll talk about in the upcoming slide. But that also one of the concern raised by them. Any other fee should not be included as outstanding principal for the compounding purpose. Even though the customer borrower is going to repay the loan in the principal amount, how will that have an impact on the charges and the repayment capacity point of view? And then the fair and respectful treatment of the borrower. There are two main concerns. One is that with respect to the recovery point of view, how multiple people will keep calling them and threaten them for the repayment, while RBI has clearly come up with aspect that this requires a mechanism from a recovery perspective, where they need to communicate upfront their recovery agents, their numbers, etc. And also while they're going to sanction the loan, they have to clearly communicate in the agreement who will be the borrowers, etc. And also at the time of, probably the recovery agents, both offsite and onsite should be required to under adequate training. It's normally good enough that you have a proper, agents, but they also need to know how to talk to the borrowers to collect the money, how to treat them with the respect. But rather, I would place public sector much better way than the private sector bank. The way the public sector, probably follows up for the money collection, they do have some respect to the customers rather what private or the NBFC today they deal with. And then the formally disputed repayment should be indicated in the credit report. This is where the buy now, pay later is going to have a huge say, because as per the RBI, every loan is respective of the amount are required to be reflecting in your credit report, and that will also will have some impact from the credit bureau as such, which also we'll discuss in the upcoming slide, because now they need to reflect everything in the credit report irrespective of the amount. That's going to put a lot of complex into the business operations, not only for the RE but also for the credit bureau itself, to change their algorithm and how they're going to factor all of this. Yeah. So digital lending guideline overview. We'll quickly look into the guideline overview. Maybe DP, you want to talk about this, an overview about each of these aspects?
So I think I did cover bulk of it in my part, like I mentioned, the whole disbursement, clarity on fees, and making sure to the borrower, there is transparency in terms of, what are the terms. If there are digital lending partners that you are associated with, then the clarity on who they are and if there are recovery agents that you're dealing with, then details of those, all of that need to be explicitly clear to the customer. And like I mentioned earlier, the cooling off period is something that's, a very important way to protect the customer there. And ultimately, even in areas like creditworthiness, the RE needs to have a clear mechanism and an explainable basis of how they are deciding on the creditworthiness to lend to a customer.
Sure. I'll quickly talk about this approach. One is a loan disbursement, where system development should ensure that the loan is disbursed into the account of the beneficiary. This is more in terms of the RE that they will have to look at. Collection of fees and charges was typically with the fintech earlier, but now the entire responsibility will lie with the regulated entity, where they need to see how to collect the fees and charges directly. So one is you need to develop the policy within your organization in terms of how do we collect the fees and charges from the borrowers directly, and how do we account them internally, plus the system configuration that we need to develop within your LMS and the LOS. And disclosures to the borrower, system developments to ensure necessary communications triggered to customers as applicable. So we have standard, the key fact statement, disclosures of APR, product information, the details of recovery agent and the website link. And then we also have grievance messages, redressal, which again updation the customer service and grievance redressal policies, and also the operation of the grievance management process that is also required. This is more to do with updating your procedures around how this can get addressed, updating your websites, and also if your fintech is going to deal with it, you have to get into an agreement and arrangement with them, and they also have to get into a proper training around that. And then the borrower credit worthiness is where your artificial intelligence comes into play, where the fintech will use the AI in terms of how do we evaluate the economic profile of the borrower. So the AI is required to be audited. That is what they say. But how do we audit becomes a big question. So the algorithm requires to ensure that it also considers the economic profile of the borrower. Not only that, they also say the economic profile of the borrower requires to be updated on a periodical basis. And then cooling off period, again, one more complex part of it is where if somebody is going to repay the amount in a shorter span, how are we going to, consider, reversing the charges like the processing charges, insurance charges? Are you going to repay it to them or not to repay? So likewise, there is going to be a lot of complex in terms of, how we gonna run our business and operations, that requires some sort of an insight from the business, how they're gonna deal with. So they require some updation in the policy procedures, and also we need to look into how we have to update our LMS and LOS in terms of the algorithm or the revenue consideration, which all we'll talk in next slide. But yeah, next slide. of the LSPs, policy for conducting the due diligence of LSPs was very, very critical. So if you see the first, the previous slide, go to previous slide, so 1/2. So this becomes more in terms of the RE level, what they need to do in terms of, to fix their internal policies, procedure, and setting up the application. Now, the next slide that you're going to look at is more to do with respect to, how the third parties are required to be managed from a RE perspective. The first part was more like RE to implement within their own, the organization. Now this is more to do with, governing or overseeing the your LSPs or the DLAs. So the due dates of the LSPs, which RE have to carry, they have to look for on a periodical basis on the security aspect, privacy aspect, and also the other aspects such as, they don't collect any charges, and all the data, whatever they collect are being interfaced to the RE, and thereby whatever agreement between both the parties they get into, they're ensuring that, they are putting into place and also adhering to the commitment as part of the agreement. And then finally, they also have to ensure that the security and the privacy with respect to the data what they have collated from the customers or rather the borrowers is not being misused as well. And then we also talk about the collection, usage, sharing of data with a third party. That again becomes the main point. So RBA states that the data that are required to be collected should be at the bare minimum. So there is no regulation today that says what is the minimum data that is required to be collected. So what is minimum is what we all have to think through. That is where the experts comes into play. Still the data privacy policy unfortunately is not out. So thereby there's no reference to the data privacy policy. But what RBI states is that the data what is required to be collected should be at minimum. And then how you gonna use it? How are you gonna share it? So that is where RE and the LSPs have to get into an agreement in terms of how they're gonna collect it and what is the minimum that they're gonna collect and what is required for the business. So both RE and LSP have a huge play in terms of the data collection and the data storage and the using of the data. And then talking on the privacy policy, so RE have to prepare a comprehensive privacy policy and they need to share it with the LSPs as well. But it is not really enough. Even LSP also have to prepare their own privacy policy on how they're going to ensure the confidentiality and misusing of the data, right? So RE may say that please collect only this. Don't collect anything beyond this. So then LSP comes into picture to the extent of data, whatever they have collected it, how do they ensure that they put a security controls on around the place? So RE will tell them what they need to collect, while LSPs will ensure the security and the privacy of the data, what has been collected. And then we talk about technology standards, as I said, as you have seen the previous slide, where we had a huge stack of the technology that is being used by the fintech world today. So how are we going to put in some sort of security standards in place, right? So for example, I myself did a blockchain transaction about few months back. The money got debited from my wallet, but then the money was not received on the other end. And there was no helpline for me to trace my transaction. End of the day, I lost my money in the blockchain, the transaction. So not only good enough that we use various AI, RPAs, or the blockchains, etc. But how do we ensure the security of these technologies, and how do we ensure the cyber security from these, the cognitive technology? That becomes a big question. So what RBI says is that I'm happy that using all of this technology, thereby we're innovating something within India. But again, the whole point is that how do we ensure security of those? That is where they're trying to push the fintech should have a technology standard to ensure that all the security aspects are being taken care. And then they also say that the LSPs are required to undergo technology audit on a periodical basis to ensure that their applications are being hardened and also have a minimum baseline required to ensure security and the confidentiality of the data. On the regulatory reporting, I think we spoke about two aspects earlier, the buy now, pay later. So any loans, whatever that we take, irrespective of short term or amount for that matter, the loans have to be reflected in the credit report. So not only that, while the credit report, will probably reflect all the various loans that has been undertaken, but they require some sort of an algorithm change in the way the credit bureau will probably, will consider all of these loans as well. So this digital lending guideline clearly is probably shaping the whole industry. I would say. So if fintech is gonna think it's only for them, the answer is big no. It's not only for fintech. It's across all the three REs, fintech, which is LSPs, or even the credit bureau for that example. All of them are gonna own up. They're gonna take responsibility in terms of the digital lending which is going on in today's world. Yeah. Let's look into some of the challenges against the guideline, and then I'll take the questions in the end. So I can see some question, but I'll take it in the end. Just give us some more time. So the focus area, this is a very important slide that I probably wanted to share with all of you guys, because there's something basis my research I was able to get this particular slides to you. So the RBI guideline clearly gives a way of what how the RE should be able to regulate that. But on the other hand, there are also challenges, in this guideline. As when there's always a positive, there's always a challenges on the other side. There's also a lot of challenges which RE, fintech, everybody have to go through with the guideline, because this guideline is more like a gray. I would say it does not specify A, B, and C, D to go in certain matters. I would say that requires a lot of brainstorming, discussions, and how do we go about. And also, it requires a lot of revisit into your own technology, policy level, procedures level. The entire business will get a bit complex. Let's go one by one right now. On transfer of money and fee, so there is again a challenges will be the LMS LOS will become very complex. As I said, you have to create a policy. You have to have a GL assignment within your, the financial system. How do we collect the channel of, the monies and fee transfer and the collections as well, right? So you want to transfer the money to a specific borrower account through a UPI, through a NEFT, etc. And also the reverse information LSP, so that they can handle it. So you disburse the money, and now the data has to go to LSP. While it was other way around, now it's going to be that the RE have to push the data to LSP. So the operations are going to get big complex because of this arrangement, which RE was not into doing this earlier. And then we talk about a key fact statement. Though we prepare a beautiful agreement or arrangement in the key fact statement, now the LMS will have to release a KFS, right? So thereby your LMS or LOS requires some configuration change where it can generate this KFS on its own. So thereby you need to go back and revisit your LMS and LOS applications. And sharing of agreements and signing, though I'm really happy that a lot of digital innovative is also in way to this guideline, which the government is trying to achieve. But on the other hand, how much is the consumer are able to be aware, right? They're very hunger for the money. With a click of the button, they get everything. But are they really going to read into all of this? Are they really going to understand all of it? Big question, right? So you go to a village, or rather, where they don't even know what it is all about. So they're not going to even read into this. So they require a lot of awareness that we have to create, what the consumers have to be aware of, and what is the amount of education required on these aspects is also very much key for a big success of this, the digital lending guideline as well. And then the regulated entity onboarding, technical abilities, data privacy concerns, storage system, data security, fairness in conduct, ability to conduct with regulation and status, right? The point is, if you look into how many LSPs today are really capable with all of these 6 bullets that I spoke about, we may end up with only a few handful of the fintech companies compared to the ocean of the fintech that we have today. So that is where the business for them to onboard a new fintech is gonna be challenging, because they need to understand, evaluate, and vet the third parties or fintech companies or LSPs in these aspects. So they may onboarding a new fintech company or LSP is going to be a big challenge, because they have to evaluate all of this. Plus, the existing fintechs also have to go through and ensure they have all of these all of these are being taken care. So they also have to, probably really go shifting their entire process and also, upgrading their operations, etc. As I spoke in the previous slide, as Durga has also spoken in the previous slide, the small players may find it very, very difficult. So thereby almost it will become like the small players may be, trying to be away of the business, but it's not about, pushing them. It's about bringing a lot of security and also the privacy and a transparent way of, dealing the operations. Just go to previous slide. There's a talk, which tells you now technology standard, data privacy. There is no guideline in terms of what is required to be implemented or what is required to be taken care. That is where what suggestion is that RBI has not released a guideline for due diligence, but RE can follow the previously issued direction of outsourcing. There's an outsourcing master direction which RBI has released. So that can be used for RE to do a due diligence on the third parties. Right. So I just want to bring that also on the today's session, because it's again a topic going on, on what basis do we do a due diligence. Yeah. Other focus area was on the digital lending gap. So the privacy policy and technology standards becomes the challenges because, as I said, RE will dictate what they should collect, while LSP or DLA will, ensure they collect only those data, and they have to put a privacy policy in place to ensure how the data will be secured while they are storing the data into their cloud or in the servers. Cooling off period is again a big concern because it requires a lot of thought process and discussion within the management. It also changes to the policy level because while somebody is going to repay the principal in a shorter time period, how the processing fees are going to be dealt with? Are they going to repay the refund the processing fees or the insurance money for the entire period? But if they're going to repay the money in probably 2 days or 1 day or 3 days, are they going to refund the insurance charges? Again, there comes a question for how many days the cooling off is going to be set, right? So thereby the shorter loans becomes the big challenges in the today's world, because you're going to keep more and more of the shorter loans. The repayment may happen quick, and thereby the business may become very complex, and then the revenue may become big hit because you will not end up getting much of interest from the borrowers. So thereby the revisiting on the product portfolio or the charges what we collect, all of them really require some sort of a business decision to be made at the RE point of view. And then the key fact statement, as I rightly said, the complex revenue structure to be embedded, difficulty in dealing with the shorter term loans, cost of business will be really high because you have to upgrade your LMS LOS. There's going to be some cost involved on the due diligence part of it. And thereby you have to also do it on the fintech, right? So thereby there's going to be a compliance cost involved. And thereby fintech also have to undergo specific, the audits as well. So there's clearly some sort of cost is going to go high, not only on the operations per se, or also in terms of, the onboarding and fintech as well, where fintech have to have all of these certifications while they come to an RE to be partnering with them to get into this whole business. And then increasing credit limit may have a minimal impact in the today's business, but the credit limit increase is also going to impact the business because they can't really increase the limit and then charge the borrower for that. There has to be a proper rational and agreement by the borrowers whether they can increase the money or not, and which also requires some sort of an economic credit worthiness of the borrowers to be revisited. And then we talk about due diligence. Again, identify the right vendor will be a challenge, which will be an immediate concern, as I said in the previous slide. If you want to onboard a vendor, you need to look into all the technical abilities, whether they have a privacy policy in place, which was not the case earlier. So if any LSP want to approach a NBFC, they have to ensure they put all of these into place quickly so that they can partner with an LSP. So and then the cost of audits to be performed also is going to be looked at. And the personal data, which Durga Prasad also was mentioning, that one-time access. So earlier, so there was not the option wasn't there that as a LSP I take an access for the entire data. But whereas now RBI has said the fintech should also have an option of taking a one-time access to the data, which requires some changes in the technologies which LSP is going to use, how they're going to probably embed or change their configuration to move from having the complete access to one-time access as well. So they have to give that option to the customers in that case, and they have made it very clear: no storage of the biometric data. Data storage is again I think that's where the government is pushing a lot, where the data should not be stored outside India. If at all, if your fintech is going to share the data in the cloud, which will be reside in the data center in Australia or US or UK or in Europe, that they say the data have to be stored within India. There's also other alternative which was issued where the data have to be stored within outside India. The backup have to be taken, and then the data should be available for your regulatory requirement, also for the audit committee and the board of directors. Plus, the data after taking a backup should not be modified. There has to be an audit trail that proves the data after the backup is being taken has not been modified. So likewise, they have to take a daily backup of the data. That's again the data storage requirement. The other critical aspect is that what type of a data that can be held by the LSPs, what type of data can be collected, what can be held, the length of the time the data can be held again becomes a big question. Restriction on use of the data destruction protocol. So these are some of the challenges, though RBI said the data storage to be looked at, but what happens to these points, right? What happens to these aspects? So how do we implement these? That is where the expertise comes into play, where they give you an advice against the various leading frameworks that we have in India, also globally. They'll be able to advise you on that. On the next slide, on the regulatory framework, credit bureaus have to redo their sourcing algorithm, as I spoke in the previous slide. So a lot of small loans will be taken and the same will be reflected. Buy now, pay later will be going high. I think your screen is lost. Yeah. Sorry, guys. Just give us a few seconds. Yeah, the screen is lost. Yeah. So the demand will rise if not regulated. As I said, the cost of demand will go high because they are triggering and the purchase of the buy now, pay later apps. And then what happens is that the demand and supply will have a mismatch. The inflation will rise. So they require some regulation around the buy now, pay later. Technology data requirement need SMBs to audit on credit underwriting algorithm, ethical artificial intelligence. That is where the key word what the working committee also referred to as ethical artificial intelligence, because they feel that the AI becomes a backbone of making a decision whether to grant a loan or not to grant a loan. So thereby they say the AI should not be biased towards providing a loan to X or Y customer. So they say the AI should probably be ethical enough in judging the customers and probably have equal products for everyone, thereby not having any biased decision towards the borrowers, thereby knowing their weakness, lending them more, so there's a potential to collect more money. So they say the AI should be able to look into economic profile, should not be biased, and they also say that should be audited. That again becomes a challenge because how do you want to audit that? And then data privacy on the SMS. So a lot of SMS comes around today while you register for a loan, etc. So they say all the SMS should be protected, and the security of the SMS also should be ensured, which means that only limited information should be published on the SMS, and it should also require to be masked as well. Yeah. So we quickly look into the responsibilities of the RE, payment of fees and charges, borrower creditworthiness, provide the key fact directly to the borrower, due diligence on the LSP and DLA, policy, procedures, standards or collection of data, storage, security and privacy of the data collected and stored. So all of this, the RE have to prepare it and they have to share with their LSPs or fintech, which the LSP fintech have to adhere. So they have to agree and then they have to ensure they adhere to these particular procedures and policy as well. Provide the digitally signed documents like KFS, the sanction letter, terms and conditions, etc. To publish a list of LSP and product information, recovery agent details on their website are also with the agreement. Nodal grievance redressal officers required if the REs while they display the recovery agents and what is the responsibility of the LSP or a fintech. If still there are some other issues with the LSP or a fintech, the borrowers can reach out to nodal grievance officers as well. And the LSP part of it, so they are responsible with most to do with the technology standard and privacy policy. Moving on the right in the clockwise direction, audit logging becomes the key because they store the data. So they require an audit logging in terms of all the data, who is modifying it, who has accessed it. So they require an audit logging in both in terms of transactional data as well as the KYC data of the customer as well. And then storage of data, where they're storing the data. If they're storing the data outside India, as I spoke in the previous slide, there's some regulation that talks about data localization audit to be carried out. It is also required to be published as well to the RBI. And then the policy guidelines on the collection and storage of the data. Consent from the borrowers for the use and sharing the data becomes very key. They need to take a consent from the borrowers before they share the data with any third party. Grievance redressal, not only enough that you publish it, there has to be a procedure, which is a standard operating procedure kind of a stuff for the team who is looking into this. Plus, it also requires a proper training and awareness to be created on how to deal with the borrowers in this aspect. Adherence to the RE agreement and policy because they are being subjected to the due diligence and also to an audit, technology audit on a periodical basis, where the RE's policies becomes and agreements becomes a key for them to agree upon. Quickly on the approach, what is that we need to do is the current state assessment to see where RE is and where is the LSP or the fintech, and then update the policies and procedure, both on the operational part of it as well as the technology part of it as well are required to be updated. Collection of fees, charges, grievance redressal, security, privacy, for all of it, you need to update your policies and procedure. System functionality review, as we spoke in the previous slide, LMS and LOS are required to be relooked at for certain functionalities to be either implemented or to be updated. And then we have a DLA and LSP audits, which is required to be done on a periodical basis. Implementation PMO, where you can probably have a third party who can assist you in the PMO part, because some of these guidelines are really gray, which requires some expertise for you to throw some light, or rather give you some sort of an area of the SME perspective, what is required to be implemented. And then there's something called agreed upon procedure reporting, which is more like a signed audit report in terms of whatever that LSP have to agree or adhere upon specific policies or a procedure or as per the guidelines which RBI has come out with today. If they have to agree on, right, rather than you doing a due diligence, the agreed upon procedure reporting will be very handy, because that becomes an independent signed audit report, which will tell you where the LSP or a fintech today stand with in terms of all the various policies and procedures and also the regulatory requirement as well. And then we talk about the third party SOC 2 reporting. The SOC 2 reporting is more to do with the security and the privacy, and also the other areas in terms of the commitment towards the RE's privacy security policies and some technology configuration like the audit log, one-time camera access, artificial intelligence algorithm, changes to the algorithm. So all of them comes under as a bundle in SOC 2. SOC 2 is more like the framework issued by the American Institute of Certified Public Accountants, AICPA, where they give a set of criteria around security, confidentiality, and privacy. So all of these three aspects as various criteria that an organization have to have at the bare minimum to ensure that they have a good security, confidentiality, and privacy practice in place. With an absence of a data privacy, this will be a very good framework that your LSPs or a DSP can probably follow. I would probably request the REs to request for some audit report. Rather, they can also push for a SOC 2 audit report. There's also a signed audit report, that is independent auditor signed audit report as well. Yeah. So some of the points which require some more clarity on the guideline, or rather I would say a way forward from here. There are a few pointers that I would like to share based on my interaction with some of the industry leaders as well. So what actions will be taken on breach of these guidelines becomes a question, because there's no clarity around what will happen if I don't adhere to this guideline. And then guidelines for the non-regulated entities and regulated by other bodies. As said in the first slide, there are some chit funds today are being dealt by state governments, right? And there are some non-regulated entities like fintech was not even under any regulation at all, right? So thereby there are some non-regulated authorities. So there is required some way forward, like how RBI is putting up for the NBFC and bank. And bank will get into the business, and fintech will face challenges, because typical Indian way of where banks may not want to outsource the risk, right? If they have been told that they don't need to be bothered, they'll be happy. If banks are put into a point that they are responsible and they will be owning at the risk of what fintech does, so thereby banks may start developing their own application or product which may have all of the security features, and they may get into the business which probably will be a competition to the fintech. On the contrary, even fintech is getting into the NBFC business. Now they started lending on their own. So I think both banks and fintech will get into some sort of an point of the business, both of them dealing on their own. Frameworks for web aggregator. If you remember my first statement, I said the data analytics, which the fintech today, where they take the activities of the social media platforms of all the users, which becomes a lead for the fintechs to go behind. That is called a web aggregator. So these web aggregator, what they do, they collect all the data in terms of activities what a user does on a social media, and that becomes a lead for the fintech to hunt the borrowers, or go behind the borrowers, or rather the customers who will become the borrowers later, right? So thereby there's some regulation required in terms of how the data that is being tracked in the social media, and how it is, how secure it has to be. What's some regulation around whether data can be shared, if at all to be shared. So there's some sort of a regulation really required around that. Setting up the self-regulatory organization, which RBI is also pushing, or rather encouraging, to have a self-regulatory organization who will probably take some leading in terms of setting up a technological standard, setting up a privacy policy. So they're kind of pushing a committee under a self-regulatory organization who can govern certain aspects of this fintech world today. And then fintech may also ask for the NBFC line. As I said, bank may get in, and fintechs may have a huge competition, and then fintech may get the NBFC. I think we're gonna see some sort of a mix-up of those two. So I think I'm good from my end. I think it's quite a lengthy session. I mean, I can still talk about HAS together, but I think we need to probably close it at some point. But I'm happy to take any questions. I do see some questions that has been in the chat box, so maybe I'll take one by one. Since there's one question for Durga Prasad, I think he has to leave for some commitment, so maybe I will take up that question. I also have so I have a few questions. What about where the fintech is heading towards? How long will it take for NBFC to develop the expertise of fintech and source out only the market outreach after the field team specialist? So I think there is no time, I would say. So NBFCs have to develop the expertise of fintech and source only the, I think REs may not get into the entire action today. rather NBFC may not get into the entire action today. So all that they will have to do, I think still the responsibility may lie with the fintech. That is where I think, the technology comes into play to collect the data, and also there are also the field representatives to go and collect it. But I think the digital lending is going to replace all of that process. So that is where, the more of efficiency is coming today using the technology. So thereby I would still say NBFC may not develop their expertise on this area, but rather they may still rely on the fintech. But I think the responsibility is what is getting fixed with RE today. So thereby I think whatever mechanism that fintech want to use to recover the money, is up to them. But I think they should have some ethical practice of collecting that. Responsible pricing, why would this element of a contract be left with the intermediaries? Typically, like in the case of commission agents and legacy landscape, should NBFC be not directly and wholly held responsible in the pricing element of the... That's a fantastic question. That is the whole reason why RBI has come up today. Because let me give a scenario over here. So what fintech used to do, assuming they take an interest of 10% from the NBFC, right? And they used to charge 18% to the borrower. So thereby they used to cap of 8% more than what they used to agree with the NBFC. So not only that, with respect to penalty charges, right? So they used to collect more than what has been agreed. So the amount of money that these NBFCs versus fintech, what they were trying to do, there's a lot of disparity between what NBFC will collect from the fintech, but rather what fintech will collect from the borrowers. So a lot of disparity, and the fintech, the way they're charging the borrowers become too huge. And that is where this particular guideline, if they want to push it, that there has to be a transparency between NBFC to the borrower in terms of what they're going to collect, what are the charges. So there's no role for the fintech to play. Rather, it's a reverse right now. Now, RE will pay to the fintech on all the charges. Earlier, it was fintech will take all the money, and they will probably give the portion what is required to the NBFC. Now it is going to be reversed, when NBFC will collect and they will disperse the money to the fintech on what is the required amount that they require to be, or the share, whatever that they require to obtain. So that is on the pricing element. Next part is, so we have, given that fintech cannot easily become the NBFC, will the future of NBFC merge and integration? I think that is where it will go, but I think NBFC may not merge with fintech, because fintech, if I can see, there are a lot of dominance of the fintech in today's world, where there are many fintech where they are trying to, they want to get NBFC more. So I think the fintech are trying to get a license of getting NBFC. That's what we said. But they became a full-fledged NBFC. You have to wait for the future to see how it is going on. But what I'm trying to say is that these are some of the thoughts that are going in the market today. And looking into these technical advancements and requirement, and I think fintech may find very difficult, because or rather the bank owning up such a risk or outsourcing such a risk is going to be a huge difficult task. So I think there's going to be some sort of disruption in the market today between the bank, NBFC, and the fintech. How the disruption is going to lead is a big question. I think we'll have to wait and watch what's going to happen. And that's a great point, that we need to see how the future unfolds in this space. Are you expecting the consolidation of these fintech with large auto FMCG companies in the future? I don't know if I have my partner Ravi on the call. That is a very good question, but still a question. I think even if fintech is going to merge, for example, we have there are many auto companies today, like TVS. They have their own, fintech. They have their own lending platforms. So it's going to be an interesting point to see, how they're going to integrate with the auto or FMG sector. It's your view, sir. Yeah.
Yeah, that's a good point. One of the questions is being debated is the data privacy bill. And the data privacy bill has been put on Parliament twice and withdrawn. So this way, what the mutual fund or what the NBFC and the banking industry is looking at, and then all these issues which have cropped up. So what, this is my view again, is through this regulation or data lending circulars of September 2nd and various other outsourcing circulars, somehow the bankers, central bankers are trying to take control of the situation before it is too late. And some of the regulations which are insisting on right now, it is relating to only NBFCs and small finance banks and banks. So slowly, as this regulation gets wind and people start settling down, it is going to take some time. It's not an easy regulation. There is a privacy, there is operation, there's a lot of disruptions expected, but this has been under discussion for about 8 to 10 months. So as it progresses, what encompasses the financial service industry will be moving to. RBI has put in this regulation. SEBI has already working on data localization. That is one other related thing. Data localization also. Then the audit logs, which is done a circular previously. Now SEBI has also picked up the circular, and slowly for the listed entities, there's no CLAR coming in. There's the non-compliance and regulations is also coming in big time. So a lot of these regulations are going to be put through the circulars, and data privacy also will hit. So it's just a matter of time. Other sectors will also jump in. But anyway, auto sector finance companies is another way of digital lending. So it might not directly apply to NBFC's lending, but since it's all under the financial service sector, it might directly apply to them. So all the auto finance sector companies who borrowed or using this digital apps also have to watch out. Only problem is auto sector companies have their support with financial services, but as it turns out, unlike NBFC, because the whole purpose of NBFCs was to reach the ultimate small customers and the banks would not lend. But unfortunately or fortunately, this has been rerouted through some of the smaller apps, and it's been a big issue. Because I was just discussing with some of my own customers or clients, how does this lending happen? What is the KYC norms behind it? It is very vague. One customer is varied against another app, and another app has a different norm itself. So it's going to be very tricky, because if you're going to standardize so much of these SLAs, and then operation side takes over, and then these privacy norms apply to all these digital app platforms, or at least the clients we're looking at, it's going to be quite a task. But unfortunately, the way it is all panned out, KYCs and banks all having their own norms, or NBFCs having their own norms to lend to some of these digital parties, they have to comply with this. So it's just a matter of time. This is going to go across to all other regulators. The regulators are just watching how this will happen, and all other regulators will pick up this. Maybe I answered it in an indirect way. Any questions, please? And Durga Prasad, sir, any questions?
Yeah. And I see some more questions here. Lending's decision essentially is about ability to repay and intention to repay. As such, this concept of unbiasedness needs to be read differently, not in lines of economic background as suggested. Yeah, I think I agree with that, sir. Yeah. So I think we need to look in terms of how the economic background is there of the borrowers, and basis that is what the lending should happen. Also looking at the repaying capacity of the people as well.
Any thoughts, Durga Prasad, sir, on this?
I think he left, sir. Okay. So, and other question is any time frame for the implemented Part A and Part B? So this particular guideline is pushing this, the Part B more from a new and the new onboarding of the customers, the LSPs or the DLAs. But by November 30 is the guideline where they need to ensure they put a policies and procedures in the place. And also they have to ensure the LMS and LOS are going to be updated, because post November 30, the expectation is that the RE will have to start directly disbursing the amount to the borrowers, or all the new borrowers that I'm talking about. And then will these regulations replace the data privacy? I think data privacy will have to really come out. That will be the base on what is the privacy aspect these NBFC or banks today they have to be dealing with. Because as I said previous slide, there is no privacy policy or clarity in terms of what to be collected and what to be stored and what to be modified. If at all someone has to modify it, what is that the LSP have to be dealt with. So we are going to take the experience of the global frameworks, but I think if the privacy comes out, it will be really good. So your thoughts, sir?
So data privacy is a legal thing. So most companies now looking at privacy, security, and resilience. Okay, privacy is a legal word, so we need to have some legal concepts around it. So even though data privacy policies are written, so we need to make sure that proper legal framework is put around it, even to draft that policy, because it's very sensitive. You can go from somebody who's asking payroll data, right? Payroll data, how does it fall under? How much data you can take? How much information can you put on the loan app, etc., etc., and whether you can share it with the anybody else, even the third-party provider who takes and runs the payroll. There's a clause around. So data privacy has really kicked in various firms already. But the important aspect is on the other side. Privacy, security also I mentioned. Security is the bigger animal there. So this phishing and cyber security also comes into play. And resilience is one of the bigger challenges today. If you're under attack or if you're under various threats from all the phishing and malphishing and all that stuff, it is going to be very important that each website or at least the providers are ready to come back very quickly. And this is one question we've been debating. How fast can you get the network up? How fast you can get the privacy up, and etc. It's a very important thought about it. So all these players or this digital risk, digital lenders, or even the third-party DLPs, as we call it, have to make sure all the three between security, availability, confidentiality, and resilience come into play. It's a very important thing. Cyber is a big threat today, and cybersecurity is a big issue. And the way these platforms being set up, you need to think about it. And some smaller NBFCs are easy to do, but the bigger banks and thing, how they're going to deal with the situation will be interesting to watch.
So I think Amit Chanda was raising his hand. Amit, you want to add something or want to share your thought? You can unmute yourself. Yeah. Amit, you're able to unmute yourself? Okay. So there's one last question I think I have. Regarding proper pricing and implementation, is there a lot of unregulated players which needs to be highlighted with the RBI? Is this not public? Yeah, that's a very interesting question, I would say. I do agree. It's up to the public to decide which particular product they want to opt for, and they always have an option to decline or decide whether to go or not. But the point is, what RBI felt, or rather working committee felt, is that they they bully the customers by giving the higher interest. For example, there are cases where they give 36%, 40% also. So that for shorter term loan. So that becomes more of collecting the interest from the customer, putting a lot of burden on them. So thereby they're saying that there has to be a regulation in terms of the pricing part of it. What charges you want to collect? What is, for example, you take a 3,000 rupees. I saw in an article, you're going to take a 3,000 rupees loan. The interest you're going to pay, including the processing charges, becomes 5,200 rupees. So people, as I said, there are some section of the society where they're not even aware of all of these charges. So they require some sort of an awareness, also regulation in terms of what are these charges and how are these going to be regulated, and what is the cap around these interests and etc. Though public have to decide, but I think still there's some responsibility in terms of ethical business to be conducted. That is where they are coming from. Yeah. So any further questions, or anyone to add further more?
Can I add a little here?
Yeah, please go ahead. Yeah.
Am I audible?
Yeah.
RBI does have a policy regarding predatory lending, and it does have on the kind of interest that can be levied.
Can I have your name, please?
Hello, am I audible?
Yeah, you're all. Can you introduce
yourself? Yeah, am I audible?
Yeah, you're
audible.
audible.
Have a policy. Yeah. RBI does have a policy against predatory lending, and it does speak about no processing charges for loans up to 25,000, and it does control the kind of interest rates that can be levied. I do not understand the statement you're making, actually.
Yeah. So the point that we're trying to make is that, in terms of, if I take a shorter loan, or rather I'm going to pay if I have a cooling period of, lesser days, if I'm trying to, probably they're going to repay the payment, rather they're going to repay the loan with the principal amount to be repaid. how the charges are going to be dealt with. So for example, I take an insurance, or how the processing charges that I've collected. I mean, it is not for short-term loan as such. Even for a longer-term perspective, if they're going to probably repay the entire amount in probably 2 days or 3 days, or rather 4 to 5 days, how these charges will be looked at. That is where the whole point comes into play. That is where the discussion is also being looked at by the industry also.
Madam, the point taken, he just gave an example amount, but the worrying aspect is how they're going to monitor.
There are norms.
Hello.
I will actually bring out these circulars, and I would like to have a discussion on this, because the statement of yours actually beats me. I am working for a small finance bank, heading the credit audit function, and I do notice there are norms, there are fixed guidelines issued, or is it that for NBFCs such strict norms do not exist?
Yeah, point taken, madam. You're right. NBFCs have a regulation still under thing. Banks and thing have better monitoring. NBFC, that's all. That's why you will see RBI going in one direction slowly. They're trying to remove that inspection.
Yeah. Okay.
Banks away from banks away. They are going to treat NBFCs like banks. And if you see one more circular, I don't know, it was mentioned there's a February 23rd circular on the CFS, Core Financial Service or Core Financial Solution, like a CBS. So that's the direction. You're right, point taken. If you need a discussion, we'll have. All the small banks and banks are supposed to have a CBS solution much better. But the way RBI is looking at, they removed actually the inspection cell separately. Actually, they're now having only one cell. Any writing, it goes back to the one single department under MOS. So it's a good point. If you want some discussions, happy to discuss on the same. You're right.
Let's do this later. Yeah. Sure. Thank you.
Thank you. The point on the last point is on RBI inspections would become more interesting. Yes, we need to see how the next 6 months pan out, because it's 1.5 months, 2 months they've given time. We're not sure how best these things are going to be implemented. And yes, there are various aspects in this to be examined. One of the points which Madam also raised was on the interest rate itself. But there's a lot of predatory pricing, a lot of monitoring. I know even small finance banks have given some rates to play with, but you can see a very wide margin between the lowest rate and the biggest rate to be charged. I've seen this in small finance banks as well. So again, you have a limit set, you're right, X% plus, cost plus, but then there is a transfer pricing element in these cost plus branches. So that has not been arrived at very well. I know that also. Maybe that's a different discussion for the transfer pricing element. So good point, madam. Then, but the small finance banks also.
So the risk taken by the bank. Yeah.
Yeah.
I think that's all questions we have.
So any feedback, happy to take. Thanks again for attending. Thanks Durga Prasad sir and Karthik for having a good session. But it's just the beginning of the journey. So we like to have feedback. A lot of questions even in this circular. And the way it is going to be interpreted, it's still a guidance. So there are a lot of questions as we implement some of these things. Will be interesting to note. So once again, thanks Karthik and Durga Prasad, and happy to take feedback. Please write to us. That is digital.ia.org, and more sessions to come. And if people are willing to contribute on any articles or want to take a speaking session, please write to us. We'll be happy to involve you in the sessions as well. Thank you once again. There's a session on November 3rd. I just need to update you on the standards and internal audit, because we're going to have some audit-oriented questions there, and accounting standards have also become important. So the next session is planned for November 3rd, and then followed by a session on November 9th. And there is a meeting planned, physical meeting planned at on November 23rd. IIA Madras chapter is hosting a conference. So all those things will be put on the website. Thanks once again, and have a great evening. Thank you.